This is the third in our winter beef cow series. Tonight the topic is marketing trends and monitoring and benchmarking beef cow herd profitability. This is a third in a series that our team has put together. The first was on beef cow nutrition, second one on calving, and then we'll have another one coming up in March. I'm Dan Loy. I'm director of the Iowa Beef Center. So with that, we'll go ahead and get started. Our first speaker on benchmarking your cow profits is Denise Schwab. Denise is our Northeast Iowa regional beef specialist, covering 16 counties up in Northeast Iowa. And Denise has kind of been our go-to person on our team for several years in terms of doing beef cow records, beef cow business records, spa records, and so forth. So we're going to have her kind of set the stage this evening. And we look forward to what Denise has to share with us.
Thanks, Dan. So I get the honor of doing this great topic you all are excited about in terms of record keeping, cost of production. If I can make my slides advance. There we go. So we're going to share some things in terms of cost of production that we've looked at both in the last 30 years as well as some more current things and see, are they telling us the same thing and where are we going? And then how's that affect profitability as well as looking at some benchmarking. So that's our plan for tonight. So I always like to start off by asking producers and participants, what do you think your cost of production is? Is it down in that $400 to $500 per cow per year, or do you think it's up closer to $1,000? And I would guess most folks are going to say, well, I'm down in that $400 or $500 range, right? And I'm going to kind of challenge you to think about that. But as we look at that, one of the first questions needs to be, what do you include in that cost of production when you're calculating it? I think for the most part, we're all pretty good at looking at our cash costs, right? Our direct costs, so feed, vet, healthcare, labor, some of those kinds of things, pasture costs. But what we don't often think about is those non-cash costs, those indirect costs, like ownership of the cow, the machinery, the land, family labor. Because as much as we'd like to say we're doing really well, we've got to support a family out of that operation as well. And then what's our opportunity cost? Most of us don't look at that, but that's something we want to consider and think about as well. So we're going to kind of look through some of these different bits of data here. If you look at, this is from the Livestock Market Information Service that just came out in January, and it basically is looking back at the last 30 years and what was our return over cash costs for a cow herd. And this is national, so it's not just Iowa. We can argue whether Iowa is better or not. But if you look at it, 14 and 15, those were phenomenal years, right? But that's a result of this bad year we had back here, 11, 12, 13, where we had a drought. So where we saw a lot of cow sales off, then all of a sudden cattle value was high because numbers were low. And so we saw those 2 years. But if we pull out these 2 high years right here and look at the rest, kind of for the most part, we're averaging somewhere in that $50 to $70 return over cash cost per cow per year over the long haul, right? And we see, we see that cattle cycle as a part of this. We can see those peaks and valleys in terms of profit, and they're going to kind of follow that same peak and valley in terms of cow numbers or the cow cycle. But in the long run, we're profitable in that $50 a cow range. So we're not getting rich off a cow herd, are we? But this is looking, one thing I want to point out, it's looking at cash costs. So those direct costs I talked about earlier, feed, vet med, supplies, hired labor, those direct cash costs. When we look at what was our actual cost of production over time, we look back here from the 90s and the early 2000s, we were sitting right at that $400 a cow range. Cash cost to keep her for a year. And we actually were fairly stable until we get into the early 2000s here. We started to see a little slow incline. But we get out here in about 2006, and all of a sudden that cost of production started to skyrocket. And some of that is probably feed-based. Some of it is land-based, pasture costs as a part of that. Part of it is everything else for cost of production in agriculture in general was going up. We had a pretty steep curve in there from about 2006 to about 2014, where that cost of production went up very quickly. If we look here at these last 6 years or so, I think the verdict is still out. Are we staying stable? Have we hit a new plateau? And I would hope that maybe we have hit that new plateau. If you looked at this, 2 years ago, we might seem to think we had a little bit of a decrease in cost of production, which was looking good for us. But for right now, I'd say we're looking at maybe a new plateau, a new level in terms of cost of production. But look at where it's at, almost $900 a cow, right? And that's just our cash cost. So again, this is over cash costs, or looking at cash costs. It includes pasture, but again, that's just our out-of-pocket costs. So that doesn't include any of that cow ownership, machinery ownership, land ownership, those kinds of things. So I would say most of us are probably in that $800 to $900 cash cost range. And then we add additional costs on top of it. But I'm going to share some information that goes back to a lot of what we've done on record keeping here at Iowa State, some of the partners we've worked with. This is really old data. This is from the 90s, and it's from Illinois. So the numbers here on the side of the dollars are not very reflective, and I admit that. But the driving point on this is when they looked at producers who kept records, a good set of cost of production records for 5 years or more, those producers reduced their cost of production about 30%. 30% decrease in cost of production simply because we're focusing on what our costs are and how we're managing those, which are the biggest items we can tackle and have the fastest impact. So old data, old numbers, but look at the trend line, 30% cost reduction just by keeping track of what we're doing. So I'll go back to some of our early data set that looked at our beef cow business records. And we asked that question of what drives profit. What are some of the things we first think about driving profit? Weaning weights, calf price that we're selling for, right? Maybe herd size would be some. So we looked at first at these 9 factors. So herd size, calf weight, cow weight sold, percent calf crop weaned, the value of those calves, et cetera. And then looked at what is the correlation between that value and our return to labor and management. So basically profit, what you got paid for your hard work and brain power. And you can see all these numbers are relatively low correlations, right? The highest at 0.28 for calf weaning weight, but that's still really relatively low in terms of correlation numbers. So this is trying to look at our ability to calculate returns, what's going to be our best predictor. And for the most part, all of these production and price values were relatively lowly correlated. So they weren't good indicators of profit. But when we started to look at some of these other factors, both feed or total cost per cow and total cost per hundredweight, we start seeing a lot higher numbers, right? Correlations up in that 0.4 range. Now these are all negative, which means the higher the cost, the lower the profit, but that makes sense, right? And our best predictors ended up being feed cost per cow or feed cost per hundredweight, because the hundredweight took into account both the calf weight that we're selling as well as that cull cow weight that we're selling. And then our total cost per cow and per hundredweight. And they were very good at predicting profitability. Now, sometimes we look at this and say, well, that's kind of a duh, right? You're higher your cost, you're lower your profit. But very closely correlated, and items that we can really dig into and start to project from here on out. That study also tried to look at what's the variability. So looking between operation A, B, and C, what described the biggest differences between different operations, the biggest variability? And on that one, we see here, these 8 factors that you see up here described 82% of the variation between producers and profitability. But look at number 1, feed costs, described over almost 60% of the differences between operations. Mostly cost factors up there, so feed costs, depreciation, operating costs. We get calf weight in there, interest, calf price, herd size down there, very, very low. But kind of the bottom line and driving point is feed cost is one of the most important factors in determining profit in the operation. It's a big part of our operation. And if we're going to just tackle one item that we really want to say, let's look at this, that biggest item in terms of our costs, we can probably have the most impact the fastest if we work on that big item. So we might say, well, that was from the 90s, 30-year-old data. Is that true today? I'm going to show you several slides that came from Kansas. The Kansas State University Extension, as well as their Kansas Farm Business Association, just put out a paper called A Snapshot of Kansas Cow-Calf Producers. And what they did is they did a survey of all of those cow-calf producers who are in their Farm Business Association records. So the data you're going to see here are producers who have been keeping records, cost of production and profitability records, and then also answered survey questions to help support that. What you see here, and then they broke it up into a low profit, average profit, and a high profit third. And this one is looking at herd size. So this pretty much supports the same data that Iowa State's data from 30 years ago showed you, right? You can look across those herd sizes and you don't see a trend line, right? You see a little bit of data and information in all of those. So we had high profit herds that were very small and high profit herds that were very large and everywhere in between. So low profit herds that were small and large and in between. So this would really support some of that same data that says herd size is really not a factor in terms of profitability. Now it gives us an opportunity to take advantage of some scale, right, as we get bigger, but size alone is not going to be a good predictor of profits. They looked also at those operations that were selling feeder calves and looked at both feeder calf weight, the weaning weight sold, and price. And here on the left, you see those operations that were high profit third group. They were kind of average in terms of weaning weight, maybe a little above average or the higher price in terms of calf value sold. They're probably doing some things that increase that calf value, but they weren't the heaviest calves. If we look at that low profit third, they were the lighter calves, but they got a little higher value than that middle group. So we got a little bit of difference there, but again, we don't really see a trend. So we can't say our high profit group are selling the biggest calves or the highest price. We see a lot of variability between those kinds of groups. Again, supporting that old Iowa State data that said price and weight have an input, but they're not our best predictors of profitability. This slide kind of tells the story of that Kansas data though. So if we look, here's our high profit third on the left, our low profit third on the right, and looking at expenses. So again, cost of production, just like the Iowa State data said. And you see some of those bars, a lot of those bars are very similar in size as we break out the different costs. So that top color is interest, the middle one is unpaid labor, that very thin yellow one is real estate tax, the very thin blue one is depreciation. The green one is kind of that miscellaneous catches everything costs. The yellow is vet med, don't see much difference there. The bigger orange there is pasture costs. We see some difference there, but where's our big difference in profit groups? Feed costs, right? That bottom blue bar, and we see a big difference. Most of that difference in expenses is due to feed costs between our low profit group and our high profit group. Again, supporting the same data that old Iowa State study showed. So it's probably doing a pretty good job. They also, Kansas State puts out this differences between their high, medium, and low profit groups. And so I'm going to show you some scatter plots. I'm not real fond of scatter plots personally, but I think it does a good idea to help us look at, do we see trends? So here we're looking at total income, gross income versus selling price. So the horizontal bar is selling price, the vertical column is gross income. And is there a trend there, or does that look like a shotgun? It really looks like a shotgun, right? So we don't really see any trend line between selling price and gross income. It's just kind of all over. So we have some with high price that might be low gross income, and some with low price that are high gross income. All right. So it kind of takes that calf income out of that equation, or shows that it's not a real good predictor. This one is looking again at gross income on the vertical bar and the calf selling weight on the horizontal bar. Again, supports that Iowa State data. It's kind of a shotgun pattern, right? So weight alone is not a good predictor. They've got to work together. But here's a pretty good line. You can look at that data and you can see that line going from the top left to the bottom right? So on the upper or the vertical column is return over total costs, and the bottom is total costs. So as our total costs go up, our returns go down. And we can see a pattern or a line that's going to correlate there, how those two are connected to each other. All right. Another one looking at total cost and total feed costs. So again, as our feed goes up, our feed costs go up, our total costs go up. Now we don't see quite a perfect scenario here, right? So our green circles are our top third profit group and our red triangles are our bottom third profit group. So we'll see a little spread there, and that's basically telling us feed's a good predictor, but it's not the only predictor, right? So even though we're maybe really good on feed costs, doesn't mean we don't have other costs that are out of line and pushing us up. But it doesn't take a lot of imagination to see that line going upward to show the connection between feed costs and total costs. Again, supporting the old Iowa State data. So I've shown you some 30-year-old data. I've shown you some very current Kansas data. Now I want to talk a little bit about the cow systems project that we completed here in Iowa last year. And this was a 3-year project where we looked at working directly with producers that were either in a traditional system. So basically they grazed a little over half a year and fed stored feed the other half, but kind of our traditional Iowa system. Our extended grazing system, and those would be those cooperators who grazed probably at least 9 to 10 or 11 months out of the year, really tried to minimize the amount of stored feed fed. And then our limit graze system, which would be those folks that basically provided stored feed almost year round, or what we might call our confinement cow systems. A lot of those herds, maybe they graze corn stalks, or they might have grazed pasture for a month or so, or very short periods of time, but for the most part fed stored feed all the time. And in this project, we had 24 cooperators that kept their cost of production records over 3 years, 2015, 16, and 17. So that gave us 62 herd years of records. We analyzed each of those herd years as a separate item. So if a producer kept records for 3 years, he counted as 3 years records. We didn't have a perfect split between systems, but we weren't too far off. So we had about 20 in the limited graze, about 28 in the traditional, and about 13 in the extended graze system. And all this data I'm going to show you here is available in our manual. We did put out a cow systems manual, and it's available from the ISU extension store at that item. And if you just do a Google search on our extension store for Iowa cow systems, you'll see that come up. But I'm going to share some of the costs that we saw with that and try to remember that earlier slide where I showed you what our cost of production we're doing. That on average nationwide, we're up close to that $850, $900 of direct costs. So here, the first set of numbers is going to be all 62 herd years combined. And then you can see the 3 different systems if you want to kind of look at those different systems. But I'm going to concentrate on those all records just to kind of give us an idea to benchmark. On average, we fed about $300 worth of stored feed per cow per year for each of those years. We had a pasture cost of just under $120 a cow and about $6 in residue. So for the most part, most of our Iowa operators do not charge a fee against corn stalk grazing. Maybe we want to, but if we have to put water out or fence out, that's kind of that $6 per cow cost to cover some of that fencing and watering. But in total, about $430 a feed per cow per year for those 3 years. You know? So if you kind of remember, about a quarter of that cost is going to be pasture and grazing, and about 3/4 of that cost is stored feed. Kind of an item to think about. So not too far out of line probably with some of that data we showed earlier. But the one thing I really want to point out when it comes to this data is the range of operations, what we saw between the differences. So even though our stored feed costs averaged $300 per cow across those 62 records, we had somebody as low as $45. And granted, this is that was an operation that the land had been in the family for 3 generations. So they did not have a fair market value on the pasture cost. They used kind of a very low cost for pasture, but shows again, very limited grazing or very extended grazing, very limited stored feed. And very inexpensive pasture. But we also had somebody as high as $955 per cow for feed alone. So when we look at that, you know, our target being kind of the $850 to $900 a cow total cost, we had one operation that was spending more than that just in feed alone. So huge range. If we drop down and just look at that total feed cost, again, 430 is our ballpark or our average, but as low as 167 and as high as that $955. So huge range. A whole lot of that Illinois data that showed that reduction 30% in your cost of production is knowing where do you sit in that range. Are you on the high side of it, or are you on the low side of it? And then how do we start to tackle that as a challenge as we move forward? But again, as we looked at this data, the range from the low to the high was really extreme. When we put feed in with our other feed cost or non-feed operating costs, so this is direct. So this is kind of, think about it, out of your pocket cash costs. Feed was 430. The non-feed operating would be the vet bill, the tags, the supplies, the utilities, bedding, hired labor, all those kind of out-of-pocket cash costs. Added another $254 per cow to the cost of production. So our total cost is about $684 in direct costs, cash out-of-pocket costs for everybody in that project. So how's this compare to the Livestock Market Information Service? That would indicate as an Iowa system or Iowa systems, Iowa herds, we're maybe a tick under the national average cost of production, giving us a little advantage, right? But look at the range again, 350 to 1,397. So you look at that operation that had direct cash costs of almost $1,400. They had to sell their feeder calves for more than that $1,400, or at $1,400, just to pay their cash costs. And that doesn't count land and livestock and ownership kind of costs with it. So again, where do you sit in that range? And a huge variation from one operation to another. When we look at how direct costs break out, and this is all the direct costs, you can see over on that right-hand side, stored feed, pasture, and residue was about half of their cost of production. Came out really darn close to half of your cash costs. The next biggest cash cost ended up being paid labor. And what's interesting is we did see some differences between systems when it came to paid labor. A lot of our limited graze systems had a higher paid labor cost, a lower family labor costs. A lot of our extended grazers had more family unpaid labor and less paid labor. And then our next items were kind of that pasture expense, vet med, and then miscellaneous and everything else together. But if you're going to target one item to have the biggest impact in terms of reducing your cost of production or improving your profitability, we probably went ahead for that big blue triangle, right? The biggest cost of production, which is stored feed. In our system, or in this project, when we looked at total cost of production, so we added in that ownership number. So it's not just direct costs, the blue total feed and the yellow, that's our direct costs are out of pocket. But here we added in that unpaid labor, so what it costs us to keep our family alive on that farm, as well as not necessarily depreciation, but we called it ownership costs. Then all of a sudden, ownership kind of becomes our second biggest item behind feed, right? Now, we figured on the high side here. We readily admit we figured on the high side. But let's look as we kind of take that apart a little bit. So as we looked at our indirect costs, we kind of lumped it into three values. So the cost of the cow and the bull and the developing heifers. So our cooperators gave us a value per cow. Our machinery costs, and we looked at all the machinery that a producer says they have. We let them put a kind of a market value on it. And then they told us what % of the time is it used for the cow herd. And that's the number that goes into this $691 per cow. So producers told us that, the cooperators. And then the same with buildings. So we said, if you have buildings out there that are used for cattle, what's a market value for them? For a lot of our barns, it's zero, right? Because the buildings are old and depreciated out and they're being used because they're not good for much of anything else. But we let them put a value on it, tell us what to charge to the cow herd. And then we looked at kind of a useful life percentage of that number to charge. So we randomly used 10% of the cow costs, hoping we can keep a cow around for 10 years. Now that might be wishful thinking, but that's kind of our target. 10% on machinery costs and 7% on building costs. And so you can see how we broke down those indirect costs. Is this on the high side? Absolutely, yes. We figured on the high side. We know that. but we wanted to have a figure in there, and that was the best way we could put numbers together. So when we start to look at those ownership costs, on average, these cow herds had about $286 per cow invested in the breeding herd, the facilities, and the equipment on an annual basis. But again, look at that range from $140 to over $1,000. So huge range in terms of that ownership cost. Unpaid labor, what you need to be able to pull out for your family living based on the hours that the cooperators told us they put into the herd. And we used it at $14 an hour. We had a family living at cost of $116 per cow. Again, we're seeing variation there, but probably not as much as we're seeing on some of the other items. So our labor hours, not near as much difference as what we're seeing in some of our costs. But that put our total costs, cash and non-cash, direct and indirect, at just over $1,000, almost $1,100 a cow. Compare that back to the cash cost from LMIC that was about $850, $900. That would kind of indicate, yep, we're kind of in the ballpark with what LMIC is predicting, right? Their estimated value. Once again, though, look at the range. So we had somebody that needed to sell calves for over $2,300 per head for a weaned calf, cover all their direct and indirect costs. So again, that range is maybe more important to most of us than the actual numbers. Okay. We also did what all of our record sets do. It's broke it up, looked at our low cost producers and our high cost producers. So some of the other data set is looking at profit. We didn't look at income, we just looked at cost. So low cost, high cost group. And again, you can see differences in that feed cost. So differences of between $288 and $618 between our low cost and high cost groups in terms of feed cost. So over almost a threefold difference. Non-operating costs, again, or non-feed costs in that $200 to $300 range. Ownership, we started to see more variation there. Total cost per female, a difference between $800 per cow on our low cost group and $1,500 per cow on our high cost group. So again, big range there, but on average, about $1,100 to cover cash and indirect costs. Okay. So what's that tell you as a producer? What should be looking for? And these, I'm just going to share some benchmarks to kind of give us an idea what to look at. One of the challenges I'll tell everybody first before we get into benchmarks is you looked at old Iowa State data, you looked at new Iowa State data, we looked at Kansas data. You need to find a system or a set of records that's consistent with how you keep your records, that calculates things in the same manner, in terms of having something to compare to, right? So as I pointed out, a lot of those, we're looking at cash costs, we're looking at direct costs, we're not looking at total costs. So you need to pay attention to the benchmarks in terms of what data they're giving you to compare to and how you calculate your data. So I'll throw a few out here. This comes from USDA, and this is actually 2018 data. I don't think I could find anything for 2019. It wasn't published yet when I was pulling this together. But it's a prediction of what is our cost of production, both nationally in that first column, and then Heartland, which is kind of the Midwest, and then the Northern Great Plains would kind of be Nebraska and the Dakotas to the west of us. But looking at their costs. Now, they're not calculated the same, right? They're looking at first is total operating costs. So that's pretty close to our cash costs that we've been looking at before, with the exception of hired labor. Here, in this data set, they pulled hired labor down here to other costs, beyond direct costs. But again, we're looking in that $6.5 to $7.5, $800 range. If we add that hired labor in there, we're probably sitting right at $700 to $800 a cow, right? So probably not too far off of the LMIC data that we've seen. When they put the ownership costs, and here's some of those ownership costs, so property taxes, unpaid labor, interest on equipment and machinery taxes, those kind of things, and then some general farm overhead so that we charge back to it. Now all of a sudden they're up into that $1,300 to $1,600 per cow per year range. They're actually sitting a little higher than what we saw in our cow systems project for total costs, right? So I thought we were projecting high. They're projecting a little higher yet than we are, but gives you something to compare to. Is this the best one to compare to? I don't know. I don't think so, but I'm just showing you some that you can see to look at. All right. I pulled together then, as a part of the Cow Systems project, 5 other sources of cost of production data to kind of see. My first thought was to look at, are our numbers in line with everybody else's numbers? Are they realistic? Is it sound data? And we said, yeah, it really is. We can use it also, though, to look at what are we seeing in terms of other costs of production to set some of those benchmarks. So this first column here is the data I just showed you from our Cow Systems project. The second column is our SPA records, our beef cow records, very small herds, very few operations. So use that data, take that into consideration. But if we look down at that total direct cost per cow, you know, it would say we're pretty much in line. The Cow Systems data is very comparable to our ISU beef cow records data. If we look at that middle column, that's Illinois Farm Business Association, and all of these systems report data in different manners and different terminology, and it's a bit of a challenge. So on the Illinois one, it was really hard to do a comparison other than looking at feed costs. So their feed and pasture costs ended up being $500 compared to ours that are kind of just in that $400, $450 range. Is that because their cost is truly that much higher? Maybe, might be in the way they calculate it, but kind of gives you a ballpark. Well, we're not maybe too far out of the realm. If we look at that FinBin data, that's from the University of Minnesota, and it covers the upper Midwest. So there's operations across multiple states in the upper Midwest. So Minnesota, Wisconsin, the Dakotas, Iowa, Illinois, I think, is in that database, maybe even some Michigan herds. Lots of farms in that database, so it gives us more comfort in terms of more farm numbers. Their feed cost, again, is sitting right here at about $300 a cow, and total cost at $600. So not too far out of line with the 2 Iowa State data, right? The next one is North Dakota Farm Business Association, and again, they were sitting at $380, $389 for feed and $520 total. And then over on the right is that Kansas Farm Management Association. They were sitting at $520 feed cost and $766 total costs, or direct total costs. So looking at those, are there some benchmarks we can pull out of that? And I would say probably. These are just Denise's random numbers, so take that into consideration. But as I look at that data, I'd say we maybe want to have a target of $400 to $500 in cost per cow per year, and $600 to $650 in terms of direct cost per cow per year. Will you all do that? No. Some are going to be better, some are going to be worse. Is that a problem? No. As long as you know where your costs are and you start to look at, how do I set some goals to reduce my cost of production or improve my profitability? Now, I can't say go on without saying all I've talked about so far is cost of production and profits. But if we don't get that baby calf on the ground, if we don't get that calf weaned, it doesn't matter what our costs are, right? We have no income from that cow. So reproduction is also very critical in that profitability picture. And I want to just share a few benchmarks related to that as well. So really the best benchmark tool we have, or database we have, is the CHAPS program out of North Dakota. And if you look at it from the years 2010 to 2017, which is what this is averaging here, they had over 88,000 cows in that database. Big database, lots of big operations. So really good data there. This is what I would call kind of the gold standard of reproductive data that we want to compare ourselves to, or benchmarks. And so you can see this data, you can look it up online and find that information as well. But I tried to put some of it together with the CHAPS. This first column is what the CHAPS data from North Dakota tells us. And then I looked at our ISU cow record system, the FinBin program out of Minnesota, and the North Dakota business records, because they all provided some reproductive data to have a benchmark to compare to. So as we look across that line on pregnancy percentage, you can see, I would say, you know, looking anywhere from 90 to 96%, I'd say our target should be that 93, 94, 95% pregnancy rate. But you notice what I have on the top there is per cow exposed. And that is what makes all of this data a really good data set to compare to, but it makes it the biggest challenge to keep information because we're having to keep data over at least a 1.5 years time. So it goes back to looking at what cows were with the bull in the summer of 2019, how many are pregnant this winter, how many calve this spring, and then how many do we wean this summer, fall, back to those cows that were in the pasture last summer. So that's really the key, is per cow exposed. But we see our pregnancy rates, probably a good target on there is 93 to 95% pregnant per cow that's out in the pasture with the bulls. When it comes to calving percentage, we see that range 91 to 93, but 93 is a pretty good target to shoot for, right? Now, if we get 93% pregnant, we're not going to get 93% calved, are we? We're going to have a 1 to 2% fallout probably for pregnancy loss throughout the gestation period. So we kind of have to build that in. We look down at that calf crop or weaning percentage, kind of in that 86 to 91% range. So my random targets might be 95% pregnant, 93% calved, and 90% is a ballpark target. So question becomes, do you guys know if you're hitting that? We also had some weights in here, and that's a question we get a lot is, what should my target weaning weight be? Well, there's lots of factors that go into that, right? But if we look across these data sets, it would tell us that a 205-day-old calf, we're probably shooting for about that 550-pound weight, right? We won't all hit that. Some of us will go way beyond that, but that's a target. And that would be for the calves that are actually weaned, their actual 205-day weaning weight. When we put it on pounds of calf weaned per female exposed, because we've lost some that didn't conceive, we've lost some that lost their calves and the calves themselves died, we're sitting at about that 500-pound range. So kind of another target, 500 pounds of calf weaned per cow exposed and about a 550-pound weaning weight might be a good target. Now, is that the target for you? No, you kind of got to look at what's best for your operation, but giving you something to compare to. South Dakota just put out this tool, and they actually just posted it on their website this last week, but it's a great tool to look at. Very simple, one page, front and back. The front page is where you can record your data from this year's calving, or you can go back and look at past year's calving records as well and weaning, and include some of that data. Provide yourself a comparative to look back at from year to year. And the back side of the sheet is actually the descriptions and the formulas. So it tells you how to do the calculations, but very, very simple in terms of, calving distribution, pregnancy rate, calving rate, weaning weights, all of that information and putting it together. Nice thing in here too, it's looking at what's our body condition score of cows at those different stages of production. If you think back to what we talked about in the nutrition lesson a month or two ago, body condition scores are a critical component in getting that cow to produce enough colostrum, high quality colostrum, getting her to wean back, making sure that calf is vigorous and able to get up and stand. And most of us will forget that from year to year. So this is a nice tool. It's a free download. You can go in, keep the information from year to year, and then compare back and forth to your prior years. It also will partner very well with our cow herd record book that we just published and put out in the last couple months. But basically, we've got these record books available from your field specialist, your beef field specialist. Each book holds 100 cows, but we've got sections in there, one for breeding, so we can keep track of who was with the bull. Now, if you're starting now, you kind of got to back figure who was out there last summer, right? The next section is calving. So it's looking at how many were with the bull, who was pregnant, who actually calved. We've got some weaning data in there, a place for weaning records, as well as for treatment records. So from a BQA standpoint, it's a great tool to kind of keep track of treatment records on all cows and calves and make sure we're following withdrawal times as well. So you can get that from your beef field specialist. What I think, though, is the most valuable, and it's kind of putting that South Dakota data and the calving books together, is when you can sit down and you can line up 3 or 4 or 5 years or 10 years worth of data from your own operation, looking at costs, looking at reproductive efficiency, looking at calf weights, and look for trends. Do we see trend lines? Do we see issues or concerns we can deal with? And this is just one producer I work with and his costs and data over 5 years. But looking out at that, okay, we see the cow herd is growing, right? That's a good thing, cow herd's growing. But as cow herd's growing, what's happening to feed costs? Well, they're growing too, right? So we might have hit something there between that 225 cows and 270 cows where our pasture didn't support it, we had to supplement more, right? So we might look at that as, is that something that's going on? We might be looking at what's going on with feed costs and hay costs. So as we look over those 5 years, what did hay costs do? It was on the incline too, right? So that might be a part of it. Look at the line that's vet med costs. And what happened in there? Well, we went from 30 bucks a cow to that 70 to 90 range. What happened? Did we change our vaccination program? Did we bring in a whole bunch, instead of raising our own replacement heifers, we're maybe purchasing heifers, and so we're having more heifer vaccination protocols? I don't know for sure, but look at the difference there. Why did that happen? That's one of the ways that cost of production data like this, multiple years, really can help us go back and look at what's going on with our total operation. And we can start to drill down and say, what happened in this year that caused costs to go up? Not this producer, but another one I've worked with actually was looking at pasture that he was renting, very expensive pasture, high cost pasture, wasn't as productive. You can see on his records the year he gave up that expensive pasture and went to confining some cows in a dry lot, and his cost of production actually dropped because it was cheaper to feed them in the dry lot stored feed than it was that one expensive pasture he had. So to me, the big value on records is when you can line up multiple years of your costs and start to analyze strengths, weaknesses, what happened, do we see trend lines going on? So just kind of summarize what I put together here. Our total costs are increasing. We've seen that happening for the last 15 years, something we all need to really pay attention to because our income's not increasing here at the rate that our costs are. Costs are the big driver of profitability and income. Feed costs is going to be about half of our cash cost of production. So if we're going to target the biggest elephant in the room, it's feed costs. Let's target that. Indirect costs often get overlooked because it's not an out-of-pocket cost. But when we look at our operation, whether it's buying new machinery, the new skid loader, a new feed wagon, a new manure spreader, whether it's buying replacement heifers versus raising our own, whatever we're doing on those bull costs, those are big costs that we still need to pay attention to, even though it's not a cash cost. Reproduction is kind of second to total cost, because if we don't get that calf born and weaned, we don't have income. I gave you some benchmark targets to shoot for. If you're interested in some of those, to kind of give you an idea where you rank compared to some of those benchmarks. And then I think the biggest thing is comparing your own operation over time. So less important to look at benchmarks and more important to look at what am I doing to control costs, to increase profitability, to increase the reproductive performance of my herd, and comparing my operation to my own operation. So kind of bottom line is the most important thing is that you know your cost of production. Then you have something to benchmark to with other producers. And again, looking at that industry average over time and then setting some goals for your operation. How can you improve your profitability? By targeting some focused time and effort into knowing your cost of production. So that kind of wraps up what I have today. I was just going to put up the slide with all of our field specialists. So there's 6 of us in the field and Beth Reynolds on campus. If we can help you in any way, please let us know. We've got those calving books, but we're also available to work with you guys in terms of your own cost of production or helping to put together some of those benchmarks. We'd be glad to help you out with that task. And with that, that's what I have to share. We'll switch over to our next presenter.
So our next and final speaker for this evening is Dr. Lee Schulz. Lee is our extension livestock economist, also teaches courses in risk management at Iowa State University. Lee's been with us. How long have you been with us?
8 years.
8 years. So, and we're really lucky to have him. And I'm not going to take away from his time because he's got a lot of stuff to talk about, but he's going to talk about market trends and outlook. And I've looked at his slides and he's got a lot of really interesting stuff. So Lee, take it away.
All right. Thank you. And thank you for everyone being online. What I'm going to do is really just do a cross-cutting of topics that are impacting the industry, or potentially going to impact the industry. Some things we need to keep in mind as markets certainly play a role in the profitability situation, not only this year, but as the years continue to go. Looking at current futures for fed cattle, I think really highlights what we're in for as we look at transitioning to 2020, has really been in a sell pattern. As prices peaked really to end December and into January, we look at the June contract, they've really been in a downward spiral. And it's been pretty interesting because there's a lot of positives in the marketplace, as we talk about fundamentals, but also some uncertainty has been added to the marketplace, and that's really been what's driving prices as of late. And that really revolves around the COVID 2019 virus and the uncertainty it's causing. And really not from the sense of directly impacting the cattle industry, but I think it looks at the potential for an economic slowdown. And as we've become more dependent on export markets, as we're producing more beef and getting higher value for that and exporting those products, the concern is there that markets start to slow down because you're seeing less traffic internationally. The question here with this is, how long does it take for maybe the markets to start reacting to something else or start potentially discounting this information? And I think we can point to here a study that I found out on Market Watch that looked at over history some major epidemics, health epidemics, human health epidemics, and there's a few in there, animal health epidemics, and how those impacted general economic conditions as we look at stock indices in various countries. And overall, the take home here is, if there's an impact in the recent history, it's been rather short term. I think we've already seen that in our stock market, that there was an initial reaction to this, and then markets transition to reacting to other more internal information. Now, what we would expect here for markets reacting to is rather positive news and really unprecedented news in the fact that we've had 3 big trade agreements really in the last couple months, and 2 big ones here really in the last month, with the first one being the U.S.-Japan trade agreement, with put us at really even keel, tariffs with other countries that are with the Japanese market. Now, phase 1 Chinese agreement has probably gotten the most attention, but also has probably the most uncertainty. And then USMCA, think about that as a trade agreement that really just maintains the already really good trade we already had with Canada and Mexico. Remember, 3 trade agreements, and I think it's important to look at the countries and the importance of those trade agreements. First, our highest valued market there is Japan, right? And they represent, this is for beef muscle cuts, anywhere from 25% to a little bit higher over the last several years. South Korea is in that 17 to just south of 25%. We actually had a trade agreement with them. That was actually the first big trade agreement we had. Then Mexico and Canada, anywhere, they're roughly 25% of the trade. Go way down the far right there, and that's China. So China is less than 1% of our beef cuts go to China. So while there's potential there, long term, short term, we likely wouldn't expect much growth in beef exports just based on historical patterns. Now, when we look at Mexico and Canada, and you read the USMCA, short term, it's really to just maintain the already great trade we've had with those 2 countries. Similarly with Japan, it's to put us on even playing field with the other major competitors. So looking specifically at the phase 1 deal of China, because that one has the most potential, and the most potential to rock markets one way or the other. We've already kind of seen it rocking the market to the negative. I think it's important to look at that a little bit. But here's the value of ag trade. If you just look at agricultural trade, both exports and imports, since 1970, that's obviously become very important to U.S. producers. And we can send that product to the highest value market. If we're deficit in any products, we can import those products. Breaking it down a little bit differently, we have free trade partners and non-free trade partners. That's the blue and the green lines that you'll see there. And then China's in the red, where we have obviously declined the last couple of years because of the trade conflicts we've had. Looking at 2017 is a very important time period. I'll tell you in a minute, because that's where phase one is benchmarked to. So in 2017, it was roughly $19.5 billion worth of ag trade with China. Now, when you look at this 94-page document, there's a lot of details in this document, but I want you to focus on a few of the major details, because I think this is what's driving the phase one deal. First of all, it's really just a 2-year deal with the potential for more. 2020, China has agreed to purchase $12.5 billion more than they purchased in 2017. So that puts us at $32 billion worth of ag trade. Now, 2021, it's another $19.5 billion on top of the 2017. So that's $39 billion in ag trade. Now, they say that 2022 through 2025, we just expect prevailing market conditions to continue to see growth in exports of ag trade to China. Now, we've already heard from President Xi that the coronavirus has potentially delayed their purchases. They're still committed to it, but now we've already seen the first hint of this could be delayed. And I'll point to this red line again on the trajectory of that potential trade with China and how realistic that may actually be when you compare it to where we are at with all of our other free trade partners and non-free trade partners. Remember, this is just a 2-year deal, and maybe even unrealistic as we extend that from 2022 to 2025. Also, there's implications for this too. If in fact we did see trade explode that much with China, that's going to come at the expense of sending products to some of our other key trade partners, right? And partners, relationships that we've developed over several decades in some cases. This is a survey out of the University of Purdue that they monthly ask producers several questions. It's a producer sentiment index. And I thought this one was very timely in the fact that they asked producers in January, do you think it is likely or unlikely that the soybean trade dispute with China will be settled soon? And it was effectively settled with phase one deal. But also I'll tell you that it was probably settled, and it was settled already before that. Because if you look at China exports of soybeans, it was already tremendously up in 2019, and that drove the increase overall in 2019 of soybean exports. Now, this potentially came at the expense of some of the other countries that were large growth the year prior to that. Exports of corn, we don't really ship much corn to China as it is anyways. These are our top markets. China usually ends up in this other category. And remember, this is all tied to value of ag products in US dollars. If we look at corn prices and soybean prices, it takes a lot of corn and soybeans to get to $32 billion. Also, it's prevailing market conditions. And the United States isn't the only player in this global market. And the global market is rather flush with oilseeds and corn. US was down last year, as could be expected from the prevented planted acres and the impacts on yields. But the foreign market seen larger production. And so the only reason world production in soybean was down was because of the US. Same could be said for corn. World was down 11%, but the US drove that exclusively, down 16%, although the rest of the world was up 5%. Now, what's been a bit of a barrier here too is the strength of the US dollar. So as the economy has been booming, it's great for investors here in the United States. It's great for us to travel, but it also makes our products a little bit more expensive. So that's been a barrier to trade in some regards. Now, next I'm going to talk about the ones that have the biggest potential. And obviously it's pork. And for a variety of reasons, culturally for China, they're the largest pork consumer, they're the largest pork producer, and they're dealing with African swine fever that's roughly lost 40 to 70% of their inventory. Now, this was how much the world had bought of U.S. pork at the end of 2019. It's been much larger than any prior year to this, and 90% of that was China. Now, China hasn't taken delivery of that yet, but this is what's hanging out there of potential. And with a phase one deal, that also, I think, helps get this to leave the port and to actually deliver to China, where many times China was notorious for canceling sales that they had once made. We look at the first 5 weeks of data of pork exports. They're up tremendously compared to a year ago, not only in China, which is the middle column here of accumulated exports. China is up 7,000%, but other countries are up as well, or major export destinations. And then this is the product that's on the book. So China is up 800% compared to this same time last year. Mexico is actually down, but Japan, South Korea is up in purchases. Now, what we're going to talk about here specifically is beef, right? And so the phase one agreement did make some changes to the guidelines for them, for China importing U.S. beef. Now, the debate is how large of effect will this actually have? And I'll go back to they've been importing less than 1%. So even though we've changed some of the regulations and some of the non-trade technical barriers to them receiving beef, it's probably much of a longer term impact than a shorter term impact. And that's, I think, really what the data has borne out so far. So for the positive is beef exports are up very strong. We look overall, exports already that have been shipped and the check delivered are up 3,000% overall to all countries. We're seeing large increases in Japan, South Korea, Mexico. China, yes, is up, but if you go from a positive number to 0 the year before, that's pretty easy to see a large increase. Yes, they bought more, 33% higher than they had on the books this time last year, but I fully expect this to be, in aggregate, a pretty small number as the year goes by. Will it be the record largest imports of U.S. beef from China? Yes, that will be the case. But this is to help them meet their phase one deal agreement, as well as meet their commitments to their consumers for protein that they're deficit in currently. A little bit about just the crop situation here in the U.S., because obviously this drives many producers that are diversified, but also our cost of production for producing livestock here. This is a corn supply and use balance sheet. The main implication here is I think you have to take these numbers with a grain of salt. And the reason why is USDA is really hamstrung as they put their projections together. What they have to assume when they're putting 2020, 2021 marketing year together is that all the acreage that was prevented plant goes back into production. That puts us back at rather large acreage of corn production. We go back to trend line yields, and it gives us a rather large supply number. A supply number that does a bit outpace demand, even though demand is rather strong here, especially from the feed and residual. Ethanol demand remains strong, but you'll see here a fairly large carryout and a season average price of $3.40 per bushel. That's exactly the same case for soybeans as well. Those acreage go back into production, back to trend line yields, large supply, and 885 for compared to this year's season average price of 2019-2020 marketing year of 875. Now the question to ask is, how much will USDA have to revise their number, right? And I think as you've seen moisture we had yesterday and how saturated the soils are, that our winter precip outlook maybe isn't for extra moisture, but spring, as weathermen are forecasting now, is for a rather wet spring. We're probably somewhere in between going back to all of that acreage coming back into production and the prevented plant that we've seen. Some of those marginal acres probably do not come back into production. That's going to impact the planted acres, the harvested acres, potential impact on yield, and overall potential impact on supplies. The market is currently reflecting this. So remember, we had a $3.40 price for 2020-2021 marketing year. The futures market, after I adjust for a national average basis, has $3.80 priced into the current futures market. Similarly, for soybeans, while not as large of a market bump, it is larger. So $8.85 in the soybean market and about $9 when we look at soybean futures. Now, although we may be seeing stronger prices, the market really hasn't offered much of an opportunity to lock in profits or above average profits, where we've seen prices or those margins about as low as the market has offered for this current marketing year, and even worse for the 2020-2021 marketing year. So what's the implication? There really hasn't been much of an opportunity to do any pre-harvest marketing, and folks that have been storing grain haven't got much of a market rally to incentivize bringing that grain out of storage unless they need to for reasons of cash flow. Now, the wishful thinking here is, and what we've actually seen historically, is we do get a spring and summer rally in those prices. And I think, importantly, this year is going to be very important to take advantage of those when we do see them, because of what we're potentially dealing with for the larger supplies if we actually see that acreage come back into production. Transitioning a bit to the cattle outlook here, we recently had our biannual cattle inventory report that once a year we get the estimate of not only nationally cattle numbers, but also individual state numbers. I want to highlight the national numbers here because I think this is what's really driving our current markets. The highlights here are in blue. So why I shade those blue is they missed pre-report expectations by at least 1 percentage point. Milk cows, for example, were 1 percentage point higher than many analysts expected. A lot of the reason driving that, I think, is we've actually seen some of the highest milk prices in the last several years. That likely incentivized producers to hold on to a few more cows. You've seen a little bit more aggressive replacement rates, and those numbers were a bit higher than analysts expected. We look at the beef cow replacement numbers. This one was much larger, so 1.6 percentage points larger than what analysts had expected. So the implications here are that this may be a slow decline in the current size of the cattle herd. I think what also is going on here is cattle herd has been aging. So it used to be one of the youngest cattle herds we've ever had in the current cattle cycle. But as we've transitioned to the 2020 decade, those cows have gotten older. They made a lot more sense when profits were a lot stronger. And those older cows, I think, were transitioning out of the herd and maybe seeing replacements with just the replacement heifers here. Now, these other heifers are heifers that are not going for replacement and are going to go into the feeder market. Now, this one was much lower because there's more heifers in here. Now, these open replacement heifers could become other heifers, right? And feeder heifers potentially if kind of the market outlook does dim. But here, analysts did expect, we were going to see a lot more other heifers show up. Now, that has implications for the feeder market, that if we see fewer feeders there, that means feeder cattle supplies are a bit tighter, and that should help a little bit with feeder cattle prices as well as fed cattle prices. Interestingly, here we've seen this under 500 pounds that was up. And it's kind of interesting in the fact that the calf crop was down. So how could you have these lighter calves up with the calf crop down? A lot of industry chatter there is we just had later weaning this year. They kind of showed up in this category as opposed to in the feeder market. Now, what's been talked about a lot in the industry is we've seen really large beef cow slaughter. And this, prior to the cattle inventory report, had a lot of people worried, like, are we going to see some massive liquidation of the cow herd? Especially in the fourth quarter when you've seen about 15% increase in beef cow slaughter. And you heard some pretty stark stories of large numbers of cows going to market. Overall, we had roughly 5.5% increase in beef cow slaughter. Now, I don't necessarily like to look at beef cow slaughter because we have a lot more cows, so you'd expect we would slaughter more cows, even if you held at a traditional culling rate in your herd. What I like to look at is the culling rate. So if you look at beef cow slaughter in 2019 as a percent of what our beef cow herd was at the beginning of the year, we're at 10%. That's about at kind of a steady state that's starting to decline the beef cow herd. That's a lot less stark than looking at some of these numbers and these blue lines where there's much larger beef cow slaughter. So what that tells you is, yes, we're slaughtering more cows because we have more cows, and we're starting the downturn of the current cattle cycle. What I think is important to look at, because we actually see a larger beef cow replacement rate than maybe we expected, is, well, how do these potential replacements pencil out over this downturn in the cattle cycle? We developed a tool at Iowa State University. It's net present value of beef replacement females. It's a cell-based tool. What I did was I plugged in a bunch of numbers and got the results here, and that's what I'm showing you here. What I did was say, well, what if you purchased or raised a heifer that you're going to get a calf here in 2020, and you expect 7 calving opportunities. Your discount rate is 5%, or your opportunity cost on money. So if I wasn't going to buy this heifer or tie this money up in developing this heifer, I could have put the money in the stock market, or I could have done something with this money, bought a site CD, and got 5% rate of return. Then I'm going to assume some weaning weights of 525 for steers, 485 for heifers. You're going to have to trust me on calf and cull cow price. I'm just going to make my best guess over the next 7 years. And I'm going to assume an annual cow cost of $600. After listening to Denise talk, that's pretty low, right? But it's going to help make my math work, because when I put all this data in, I get a max bid price of $13.92. And why that's important is when I kind of did a rough survey of the industry, just calling folks I know, they said replacement heifers are going for about $1,300 to $1,800. It's a good rate, right? So this is kind of at the low range. If I would have had this higher, it would have been, actually, I could only afford to pay less than that to make this pencil out over the 7-year calving. I want to highlight here, because I think this is sometimes not fully considered, is I don't pay this replacement off with calves. That calf line is that straight line there. What do I need? I also need that cull cow. That investment pay off in this 7-year period. Now, I think this example isn't really that beneficial, because a lot of these characteristics are very operation dependent, right? And your cost of production could be $600 per cow. It could be $1,200 per cow. We could see prices that I expect, or we could see prices increase or decrease over the next 7 years. right? And there's a lot of examples of that. So what I think is you really need to look at some sensitivity analysis and identify your comparative advantage, which may afford you the opportunity to pay more or not allow you to pay more. So some examples here. If I say, well, instead of 5% rate of return, I only need 4. Well, then I can pay $14.62 that replacement, and I'm going to break even in 7 years. What about if I get an extra calf out of that? Because that's a lot of times, well, we've seen that when we're paying $3,000, $3,500 for replacement heifers back in 14 and 15. Well, now I care about the longevity, right? I was hoping 10 years, now I need 12 years. Well, actually, I can't afford to pay all that much more. And a lot of people call me on that of, well, that makes 0 cents, right? But think about it from a discounted cash flow standpoint. So $1 today's worth a lot more than $1 in the future. So that 8th calf, yes, it's worth something, but that's 8 years from now. I could take that money and invest it and get a payout in 8 years. Why that's also important is calves, the first couple of calves are much more important than calf number 7 or 8. So you need to identify the most productive cows in your herd and understand that you want to be paid today as opposed to paid in the future. Weaning weights have an impact. So this is a lot of times maybe why I buy a replacement heifer instead of raise one my own. I can get some genetic progress a little bit faster. And if I can add 25 pounds of steers and 15 pounds of heifers, that's worth roughly here $150 more I can pay for that replacement. If calf prices and cull cow price are 5% better than I forecasted, I'm almost about $200, and I am at $200 or $300 more. If I get to annual cow costs, then I decrease by $50. Now, these are not all one-to-one changes, right? So a $50 decrease in cow costs, that may be a lot harder than just saying I don't need to make as much money, right? Or that putting 25 pounds on weaning weight for steers, 15 for heifers is a lot different than 8 calving opportunities. Right? So these aren't just there aren't one-to-one trade-offs. Also realizing that there's trade-offs from these, right? So if I decrease my cow costs, that has potential for impact on weaning weight. Right? It has impact on calving opportunities. We don't really operate here in silos. These all have an impact on each other. Profitability-wise, 2019 actually was rather low if we look historically, and especially the last couple of years. And that was really driven by the slide in calf prices that we've seen really from the second half of the year on. 2020 looks to be a bit better year. What is that driven by? Well, it's a lot driven by the revenue inflation because costs have improved and stabilized really at minimum. So the percentage in December 1 hay stock, so this was a rather perilous situation coming into last year. We fed a lot more hay over last winter because it was such a cold winter. We had harvested less than we did the prior couple of years because we've seen lower hay production. We have more beef cows. So May 1 hay stocks were the second lowest in history last year. We needed a great grazing season, a great harvest season, and for all intents and purposes, we got it. So Iowa increased hay stocks 6%. Missouri was the largest, 64% increase. Overall, nationally, we've seen about a 7% increase. The Eastern Corn Belt, where we've actually seen the most cow culling, did actually decline from the prior year. That was not so much an indictment on last year. Previous year was just so good. Hay prices, we've seen hay prices have trended up, but what really has developed is kind of a wedge between alfalfa prices and other hay or beef cattle hay prices. And if you read the Iowa bi-weekly hay report, what comes out of that is we don't have a quantity issue, we have a quality issue. So if anything, last year and the wet weather we had really put a divide between quality hay and alfalfa hay in particular, and what we typically feed beef cows, right? Or beef steers that need some form of forage. So really not a huge issue there. More of an impact, obviously, on dairies than beef cattle operations. As far as revenue, cold cow prices have looked much like they did a year ago and actually 2 years ago. We haven't seen what we've seasonally have seen in the past, where we've seen a rather large increase into the spring. I think this also had contributed to the large slaughter in the fourth quarter, was that there hasn't been that much incentive to hold on to those cows into the next year, and a lot of those producers just dumped those cows. Also, if we were selling at lower calf prices, this helped out with the cash flow scenario as well. Now, while 2020 looks to be actually stronger calf prices, we see in 2019 really a slide in these calf prices here of a rather large decline, and really when people are marketing calf. So why driven below break-even profitability for many producers was that lower calf price. You see the green here, we're kind of starting where we did a year ago for those calf prices. Feeders were a bit better, where we've seen double-digit decline year over year in calves. Feeder cattle market was down about 6% for the annual average for 2019. And again, prices are about right where they were a year ago. I think it's important to talk about backgrounding because a lot of producers did that last year. And I think that has implications for the revenues they're going to receive for last year's calf crop, but also looking at current potential for some background, adding some weight to this example being 7-weight calves. Example I like to go through where you think about if I had a 7-weight calf today, either I could buy one or I had those on my operation, could value that at 146 per hundredweight. Well, what if I added here 50 pounds, 100 pounds, 150 or 200 pounds to that feeder steer? If I assume some average daily gain, gives me these days on feed, and gives me these sell dates right there. If I use the feeder cattle futures price adjusted for a basis, I use beefbasis.com to do these projections, I get these sales prices. And then projecting out the value of gain here at $1 per pound or $1 per head standpoint shows that it's not very optimistic as a value proposition for adding 50 pounds. Probably can't do it for 37 cents. Now, as I get later on, we see some strength in the feeder cattle futures, so suggesting potentially higher prices, and I'm marketing at heavier weights. There may be some opportunity there, but it's probably pretty close to break even for many operations. So not a lot of incentive to add weight to calves. But I'm more interested actually in the producers that decided to do that last fall. Why am I interested? Because I was telling producers. Because we were at prices here. We look at here, and there was quite a bit of carry in the market. There was higher prices in 2020. It was pointing to, yes, I can market at higher prices and heavier weights. It was kind of a no-brainer. And this being the example here. Dr. Loy is blocking out my major. That's fine. No. So on December 13th, and this was a pro-ag meeting, extension meeting we had, I had 600-pound calves, and I could value those at $149 per hundred. If I added 50, 100, 200, or 300 pounds to those calves, it gave me those marketing dates. So some of those have already ellipsed, and I can show you how I did on the projections. The sales price I forecasted there showed that really I could be pretty wrong on those prices. My costs could be pretty high. It made sense to background calf. Right? If I assume roughly 80 cents per pound of gain, I'm making money on selling those calves at heavier weight. Right? and where it maybe was below break even, as some of those forecasts showed, maybe this is a way to add value and increase to profitability. Now, it had cash flow implications and it had tax implications. If I marketed compared to 2019 into 2020, but it could add some value here. Well, let's see how I did. Actually, prices were a bit better than forecasted. The profitability or value was better. Or first two here. We're not quite to March yet, but that's what I'm forecasting now, which I go back here is a little bit worse, but still, if I'm comparing to an 80-cent cost of gain, still would make sense to hold on to those calves. And similar in April would make sense to hold on to those calves. But that has declined, right? And I think there is some risk in the market as we've seen this big slide here, but now we're in kind of this buy pattern. Cattle feeding sector, from a marketing standpoint, we have marketed cattle rather aggressively and are at much lower levels of cattle over 120 days. This is a positive sign of the market that there's not a whole lot of market-ready cattle. At least compared to a year ago, there's less market-ready cattle ready. So that suggests that the supply isn't outpacing the demand in the marketplace. But we've seen prices really decline here. I think this has really been caught up with a lot of the turmoil that a lot of our markets have been facing. It's not just cattle, it's hogs, it's corn, it's beef, right? It's a lot of the market uncertainty, both economic, both export uncertainty, that's really driven these markets down. I also want to put a warning out there because we all know what happened back here in August and September. Really now what looks to be a blip in the market as markets significantly rallied there. But because we have tighter capacity utilization now, so we've increased the beef cow herd, right? We've increased feeder cattle, we've increased fed cattle. We haven't changed packing plants. We've actually decreased packing plant capacity. And so any issue that we have, disruption in that, is going to have a much larger impact on price than if we were up here. If we had excess shackle space, if we lose a packing plant goes down for a couple weeks, a week, we have disruptions of weather, anything like that, the impact is likely larger now than it was in the past. Why I highlight that is I think that's just one more reason that price risk management is important. We're at a situation where actually 2020, I'm forecasting profitability for feedlot producers. It's a model we use at Iowa State University. It's a cash market model, just really hand to mouth. I'm buying feed as I need it. I'm selling cash cattle, not doing any risk management. Now, what if I told you that earlier in the year, you could have hedged a much higher profit? Would you have? That's a question it's easy to ask in hindsight, right? But I ask that because maybe last year kind of gave us a prelude to this. And if there's an opportunity this year to hedge a profit, I think because of a lot of reasons we've noted, with larger supplies, kind of this uncertainty about demand, we need to look at some uncertainty or locking in some certainty in the market. So an example here, 2019, I make these forecasts at least once a month, usually a lot more than that. When I made these monthly for February, March, and April, I was forecasting an annual profit for cattle feeding of roughly $30 per head. How I did that was I just used feeder cattle futures, fed cattle futures, corn futures, to really drive my profitability estimates, and I'm using average basis levels to make those forecasts. Then as prices decline, as would be expected, profitability got as low as $82 per head loss, improved with prices to end the year at $20 per head loss. Now, 2020 was similar in that could have hedged roughly anywhere from a 27 to a mid 40 per head profit. As prices decline, that's gotten below to slightly above break. The numbers aren't all that important because, again, individual operations sell cattle different ways. They have different costs of production. But the general message is here that $30 per head profits, a pretty good year when we look to the potential we've seen out there. When there's opportunity out there, you need to grab it. Where's there opportunity currently in this marketplace? It's really for the first 5 months of the year. Those are opportunities to lock in profits of roughly $40 to $80 per head, with some variation operation to operation. Now, as we get into the summer months, it's much closer to break even, and then into the fall periods, much larger losses currently. Opportunity there to maybe use something like some put options to put in an absolute price floor, just protect against prices that would be very catastrophic to an individual operation. Now, one factor that's really driving these forecasts, driving the ability to effectively hedge, and driving bottom line profits for producers are what the prices are actually selling cattle. The way I like to look at that is basis. Basis is just cash price minus the futures price. Cash price that I use is the Iowa, Minnesota negotiated price, weighted average of all grain. Pretty good representation. Okay? We're the green line right now, so cash prices are roughly $1 under what current futures prices are for this week here in February. Now, this large dotted line is as negative as it's been in the last 10 years or so. This lighter dotted line is as positive as it's been. And then the gray and black line is kind of recent history. I think it's a tale of two stories, really, when we look at 2018 was some of the best basis levels. We had this large rally here in the spring, March, April, and then another huge rally in May that put us almost $16 over what futures. Iowa sales were $16 over futures. Now, the black line was last year, right, where it was a much more muted rally, and actually it didn't even start until May and June. We've seen actually stronger prices here than what had been average, and then prices got down to what was about average. The green line tells us anything, it's actually starting much closer to last year. So, actually, and I had been projecting much stronger basis levels, and now I'm much more kind of a little bit more muted that maybe we're not going to see the strength that we did in 2008. Maybe a little less optimistic there. Basis is also a good barometer in the market, right? So, because futures can chase cash as well. So a lot of times people think, well, futures is driving the market. Futures go down, cash are going down. That occurs a lot of times. Cash goes down, futures can go down too. But also cash, so what's happening in the countryside, if packers are really strong in demand of cattle, that can help drive futures prices. And that's what happened here back in 2000. Now, why do I think it's maybe not going to be as much of a large response as we've seen the last couple of years? Well, packers are pretty well committed for forward contract. USDA has a report, it's LMCT 153. I like to look at it just a barometer of what are those supplies that packers have guaranteed, right? So, because they don't want to get caught short in the spring. Getting caught short in the spring is bad for them, right? They got to pay higher prices. That's when beef demand is really ramping up. And so springtime, they're going to make sure they got cattle committed. And for the most part here, this year is the orange. They have much more in February than they did last year. So that's going to say they don't got to pay much higher prices because they got already a lot of cattle committed. March, about the same as last year, and they actually got 6 weeks to buy cattle yet for March. April, they're not quite there, but pretty well committed. overall, they're pretty well committed, or they have plenty of time to make. Basis levels tell us that as well. As we look at basis levels, there's dairy included in here. That's why there's a lot of large negative basis levels in there. But current basis levels compared to the heights that we've seen to get cattle committed aren't great. So for example, for March delivery, they had at least one packer had 40 head committed at 0 basis. April, $1 under. If I get into May, there's a 0 basis bid or $15 under. So packers right now are not being very aggressive. They have plenty of cattle to meet their current. So are we going to get any help from the consumer side or the wholesale side of things, right? And so beef, the cutout value right now has certainly fallen on hard times. A lot of the reason why we've seen fed cattle prices suppressed here the last couple of weeks. And really, it's not any one cut in particular that's driving this. Overall, we've seen cutout primal values lower than a year ago. Round is just a bit higher than a year ago. Now, the one thing that we need to discount this a little bit is we don't expect beef demand really strong this time of year. Beef demand actually struggles here, really kind of in the first couple of months of the year. Because we're off post-holiday spending, we're not quite to baseball season yet. Right? And baseball season is kind of the unofficial kickoff to summer grilling and to really ramp up in the beef side. Other years we've seen much larger increases, and that kind of foreshadowed a really strong year. But overall, we haven't seen that impact yet at all. My final slide, I like to put it all out there. Here are my forecasts for fed cattle, feeder cattle, and calves. So we see fed cattle forecasting roughly about what we seen a year ago, about 117, 118 per hundredweight. But more optimistic here with both feeder cattle as well as calves, which is going to drive, I think, higher cow-calf profitability in 2020, as well as, I think, some additional backgrounding opportunities and some opportunities to see some value on feeder cattle. With that, I'll take any questions from the crowd.
Okay, well, if we don't have any more questions, we'll hold up here just a second. But I do want to talk about the fourth of our series, which is starting up, will be March 10th at 6 o'clock, same place, same location. We've got 3 speakers lined up to talk about pasture management and renovation. Rebecca Vidito, who's our field agronomist in Southeast Iowa. Jeff Mathias from the NRCS office. We're hoping Rebecca's going to talk about kind of that spring management. Jeff's going to talk a little bit about CRP grazing and some of the government programs of grazing. And then Dr. Adam Janke, who's our new extension wildlife specialist, is going to talk about working grazing and wildlife into the same environment. So he'll share some information on there. If you missed our first 2 sessions, they are both posted online now. So you can go to the Iowa Beef Center webpage, iowabeefcenter.org, and pull up the link to this whole series. And you can see sessions 1 on nutrition and session 2 on calving, and watch those again. This session, tonight's session, will be posted probably in the next couple weeks. So if you see something you want to review or look back at some numbers, you can pull that up as well. Last reminder, calving books are available from your field specialist. The cow systems manual is available from the extension store. If you're looking for some of the links to any of our presentations tonight or other nights, you can get a hold of us individually or contact the Beef Center and they'll help us track it down for you. So with that, we'll say thanks so much for participating both at our sites and at home, and have a safe calving season.